Good evening, everyone. Time for another silver update. This is the silver chart on the 4-hour provided by netdania.com. You can click on the link below. And you can see we're just testing the trend line of this flag formation. We're just now touching on that. We backed off. We actually hit 33 and now we're backing off. So we're seeing a test of this. Of course, all the markets are rallying strongly on the news of this European Ponzi bailout. We're going to get into that in a little bit. You can see that the gold has rallied very strongly as well. Our old high of over 1900 is now getting within shouting distance. Our flag formation on gold, if we pull it out from the very top, you can see we're coming close to a test of that flag as well. So we're setting up for a test run, and with this bailout I think this is going to gain some traction. Oil jumped as well, not as strongly, but is up above $100 and probably going to rise further from here. The big story of the day, of course, is the move in the Dow Jones Industrial Index, which moved almost 500 points today. And you can see on the chart that was a tremendous move. You can see that we've been backing and filling and backing and filling. Then we had the big rally and we were just falling off, and then we got this gigantic bailout announced this morning. So now we're in rally mode, and there is sort of a trend line here on the Dow. Draw it roughly there, and we're coming up to attempt to penetrate that line. So it looks like the bubble is being reflated. Now I wanted to address that topic with some stories and give you some comparisons of what this will cost and who it impacts, etc. So I'm going to start off with a story that's on CNBC, and this is Central Banks to the Rescue, what today's action means. I'm not going to read most of the stories. It's a convoluted explanation of what happens, but we'll get down to the bottom line here, and he says, and this is by John Carney, and he says, in short, European banks were finding it too expensive to make dollar loans, which hurt their ability to lend dollars and encouraged them to sell euros. This depressed the value of the euro and restricted credit in Europe. The ECB arranged to borrow dollars more cheaply from the Fed so it could ease this market. So is this some giant giveaway to profligate Europeans of U.S. taxpayer money? Not quite. In the first place, European banks are major lenders to the U.S. corporate market. Huh? I don't understand how that justifies that. When they cannot participate in dollar loans to U.S. companies, U.S. credit also contracts. What's more, these are loans to the ECB, which is unlikely to default. Finally, the Fed isn't lending out taxpayer dollars at all. Rather, it's lending out newly created dollars at very low interest rates. That doesn't mean the U.S. taxpayers are not at risk here, of course. The new dollars have a potential to spark inflation. Here's your typical Keynesian definition of inflation. Well, we printed up a whole bunch of money, but it may or may not spark inflation because the inflation risk is very slight. Well, we know that inflation is an increase in the money supply. So that was inflation. It's not a matter of will there be inflation. The printing of this money is inflation. So here's your typical convoluted press explanation of what happened today. Now I wanted to take you over to look at some of the stories that are circulating about the situation that many Americans are finding themselves in this ongoing depression, as I would call it, even though technically we're not even in a recession according to the powers that be. This is on economiccollapseblog.com, and I'll link that. Tens of millions of American families are living on the edge of desperation, and the economy is about to get a whole lot worse. and he details people living in their cars, people losing their jobs, and just the poverty rate increasing astronomically in this country. He says, in a previous article, I talked about the fact that the U.S. Census Bureau recently announced that a higher percentage of Americans is living in extreme poverty than has ever been measured before. Not only that, 2.6 million more Americans fell into poverty last year. That was an all-time record. As you read this, 1 out of every 7 Americans is on food stamps, and 1 out of every 4 U.S. children is on food stamps. Tens of millions of American families are living on the edge of desperation. In many communities across the United States, there is so much despair in the air that is almost tangible. When you look into the eyes of many Americans these days, it almost seems as if all hope has been sucked right out of their hearts. Economic despair is at epidemic levels, and unfortunately, the economy is about to get a whole lot worse. And he goes on and talks about the 60 Minutes article. I encourage you to watch this 60 Minutes video about these kids that are living in a van with their father. Kind of like the old living in a van down by the river bit. So things are getting worse here. They've never been worse as bad for the poor in this country. And we can juxtapose that to the Federal Reserve printing up a whole bunch of money and giving it to European banks. Now, if that isn't bad enough, I wanted to take you on a little trip here to look at some of the people that you're bailing out. So I'm going to examine some statistics about European standards of living and European benefits and European pensions, etc., so that you can see what we're bailing out. So the first chart here is from Mercer Rankings. It's from money.cnn.com, and I'll put the link below. This is a list of countries and their paid time off with 10 years tenure. Now, this is just the average. You can't go by this as high or low. This is just the average. And you can see here that topping the list, of course, you have your EU nations. Now, these are minimum paid vacation days and public days. You can see in Finland, you have a total of 44 days off. That's 30 paid vacation days. You and I usually get paid vacation days in terms of weeks, and that's just the 5 business days. So in this case, you're talking about 6 weeks of paid vacation and another 3 weeks of paid holidays, for a total of 9 weeks of vacation. These are the people that you're bailing out. Here's France with 30 vacation days and 10 public holidays. We've got Greece, 25 and 12 with 37. Here's Poland, Spain, 36 days. Portugal, Germany, Luxembourg. Now let's go down. Oh, look at the bottom of the list. Here's the United States. And it's 15 and 10, but look, we've got a little asterisk here. If we look at this asterisk, it says, these numbers reflect typical practice amongst U.S. large firms. There's no federal law requiring employees to give a number of vacation days or holidays, paid or unpaid. So, and if you dig into the heart of this article, you'll see that there are some statistics showing that it's actually lower than that. Another study by the Center for Economic and Policy Research found the norm to be much lower when considering companies of all sizes and workers of all tenures. 9 days of paid vacation with 6 days of paid holidays. It also estimates that almost 1 in 4 U.S. workers don't get any paid holidays at all. So there's your total for the U.S., closer to 15 total days. That's 15 days compared to 45 days, 40 days, etc. So there's just one example of the standard of living and benefits of the people, the socialist nations of Europe, that not your tax dollars, but your inflated, hyperinflated dollars are going to bail out. Now let's look at the labor force exit ages for European countries. These are countries sorted by expected retirement years, and this just gives a total of how many years you're expected to have after retirement. There were a lot of figures I searched for. Many of these are very hard to find. It's not surprising they don't want people looking at these because people would be outraged. But you can see topping our list here is France, and then we have Austria, Luxembourg, Belgium, Italy, Finland, Spain, Germany, Greece, the Netherlands, then we get Canada, United Kingdom's down here, and then we have the rest of the EU and the United States here. So you can see the United States doesn't have anywhere near the number of years in retirement. The retirement ages in Europe vary anywhere from 57 to 65. Of course, their pensions are much better than the pensions in the United States. So there's something else that you're going to bail, that your tax dollars, or I should say your inflated US dollars, are going to pay for. Now, this article here is an article about how the British have the worst state pension in the EU, and it compares what the British pension is, and this is an average of £87 a week, and that is just 17% of the average wage. Now, £87 a week, that's, let's say 90, that's going to come to, let's do a quick calculation on that. That's going to be 87 times 52, and that's going to be roughly £4,500 a year. Multiply the exchange rate, that's going to come to, I don't know, 7,000 or 8,000. So very low on the scale of things. If you go down and look at the pension, this is Pension Misers, state pension as proportion of average working pay. Greece has 95.7%. Luxembourg 88%, and we go all the way down to Ireland. So Spain 81%. So Greece and Spain and Italy, here are your fat cats who are living high on the public trough, taking very good pensions, very early retirements, very, very high pension wages, and of course their countries are going bankrupt because of it, because they've promised more than they can deliver, and your dollars are going to bail them out. So here is the average monthly Social Security check benefit for a retiree in the United States, and it comes in at about $1,200 in 2011. So you're down to about $12,000 a year for your retirement, and as we know, that's going for less and less as the inflation rate rises. They tell us that we don't have any inflation. Of course, you can go down to the grocery store and see that the price of food is skyrocketing. The price of oil is still rising. We're in triple-digit oil, and the price of gas is probably going to go across $4 a gallon. So here they are. People are collecting a little under $1,200 a month, and they're taking our dollars and using them to bail out Europe. The last thing I wanted to show you is the market cap on the Wilshire 5000. Now, I chose this index because it's one that I found that there was an article that I found a linking of, and it is about how investors lost $1 trillion in one day. And this is the day back in August when the Wilshire 5000 lost 891 points, 7%, and that equals approximately $1 trillion in market cap. So I just use that to extrapolate out, and that was 891 points lost on that day. And you can see today on the Wilshire 5000, the same index, we gained 549 points. So that's a 4.38% gain. That's roughly 2/3 of the gain, 2/3 of what that was lost back in August. So we're talking 2/3 of $1 trillion. We're talking roughly $600 billion or so. So $600 billion today was added to the value of the stock market. Now that was the Fed basically printing money, and that money flowing into the stock market, and that money enriching the wealthy, because primarily the holders of stocks are the wealthy. So the bailout today resulted in the socialists of Europe being bailed out in their lavish pension and vacation and early retirement benefits, and of course the rich in the United States being bailed out to the tune of $600 billion. And then of course we've got the millions of American families that are living on the edge of poverty, who have to buy food, and because of this the price of their food and the gas for the vans that they live in is going to increase all the more, so that they can bail out rich Americans and well-off European socialists. And that's what your wonderful Federal Reserve is doing for you to help you along in this economy. So the bankers are still at it, and the bankers are still printing money. I think that the price of silver is going to rise. I think probably the stock market is going to rise as well. It's going to be inflation. Now, of course, they have their caps on silver. They aren't interested in capping other things. They're interested in capping silver because that's real money, and they want to discourage people from stacking. So obviously, the best response you could have to this is to continue stacking, and we'll talk to you next time.